Fasten your seatbelts as we dive into the roller coaster world of Disney's recent financial events. In the land of dividends and stocks, Disney once held a cherished place in the annals of many a portfolio. However, a recent article on Seeking Alpha highlighted that the magic may be fading. The author, once a staunch Disney supporter, decided to part ways with the entertainment giant, selling off their shares due to a dividend cut and years of underperformance. The reasons behind this decision are as intricate as the plot of a Disney movie. Increased screen time and an insatiable demand for content have become the norm, but these trends have not spelled success for all. The streaming wars, marked by fierce competition and high stakes, have left a dent in the profitability of the entertainment industry. Disney, despite its enchanting content, has not been immune. Adding to the financial drama, Disney's debt and high interest expenses have caused concern among shareholders. The company's ambitious plans to invest $60 billion in its parks and cruises over the next decade have further raised eyebrows. The economic sensitivity of Disney's parks division, political backlash, and rising prices at resorts have all contributed to a sense of unease. Though Disney's intellectual property remains as enticing as ever, there seems to be a shift in the winds. The excitement that once surrounded Disney content appears to be waning, a change that could impact other segments of the company. As we see, Disney's financial ride isn't all fairy tales and magic, but what does this mean for the wider finance world? In another corner of the Disney universe, a battle was brewing with activist investor Nelson Peltz. Peltz, known for his sharp business acumen and strategic maneuvers, had taken a significant position in Disney, acquiring 9.4 million shares at just under $92 per share. This investment amounted to a hefty sum of around $865 million. As the news of Peltz's investment broke, Disney stock experienced a surge, briefly reaching a 6-month high of $118 per share. This spike in stock price resulted in a paper profit for Peltz of nearly $250 million, a substantial return on his initial investment. But Peltz wasn't just there for a quick profit. He had launched a proxy fight against Disney's CEO, Bob Iger. His goal? A seat on the board and a say in the company's future direction. Peltz wasn't shy about voicing his concerns over Disney's acquisition of Fox, questioning the strategic fit, and sparking further debate within the industry. However, the tides turned when Disney announced a restructuring plan, a move expected to save the company $5.5 billion in costs and lead to a reduction of 7,000 employees. This plan seemed to satisfy Peltz, who expressed contentment with the new direction Disney was taking. As a result, the proxy fight was called off, leaving many to speculate on Peltz's next move. This move had a ripple effect on Disney's stock, which has since trended lower and traded at $108 per share. Despite this, Peltz's stake in Disney still holds a significant paper profit, demonstrating the potential power of strategic investing. With the proxy fight over, many are left wondering what's next for Disney. Will the restructuring plan bring the desired financial stability and growth? And how will Peltz's involvement shape the future of this entertainment giant? Only time will tell. With the dust settling from these recent events, what does the future hold for Disney? That's the question on everyone's mind. A closer look at these recent events reveals a few potential implications for Disney. One such event is the possibility of AT&T selling part of its Warner Media unit. If this occurs, it could set the stage for an interesting power play in the media industry. Disney, being one of the potential buyers of CNN, could significantly enhance its media presence and diversify its content portfolio. This could be a game changer for Disney, offering an unprecedented opportunity to tap into the news and journalism sector. In terms of content, Disney's relevance to the audience is a crucial factor. While Disney's intellectual property remains strong, there have been murmurs of a decrease in excitement around Disney content. This is something the company will need to address moving forward. Whether it's through innovative storytelling, increased diversity in its characters, or a renewed focus on quality over quantity, Disney has the potential to reinvigorate its brand and re-establish its connection with audiences worldwide. However, it's not all smooth sailing. Disney's plans to invest $60 billion in its parks and cruises over the next decade could be a double-edged sword. On one hand, it could enhance the Disney experience, driving visitor numbers and generating revenue. On the other hand, there are concerns about Disney's increasing debt and high interest expenses. Plus, the economic sensitivity of Disney's parks division and rising prices at resorts could deter visitors, impacting profitability. Then there's the streaming wars. Increased screen time and demand for content are significant trends, but the intense competition in the streaming industry could further dent profitability. Disney will need to find a way to stand out in this crowded market, perhaps by leveraging its unique content and brand heritage. Only time will tell what's next for Disney, but one thing is for sure. It's going to be a thrilling ride. As we've seen, Disney's financial journey is as thrilling as any of its blockbuster movies. From the roller coaster ride of its stock performance to the dramatic showdown of the Peltz proxy fight, every twist and turn holds a valuable lesson for finance enthusiasts. The future holds new challenges and opportunities as the company navigates the streaming wars, potential acquisitions, and ambitious investment plans. But one thing is certain, the Disney saga is far from over. Don't forget to hit the subscribe button to keep up with all the latest financial news. Until next time, keep your eyes on the market and your dreams in the stars.